Think about your morning routine today. You woke up and unlocked an Apple iPhone, opened Google Maps to check traffic, ordered groceries on Amazon, and relaxed watching Netflix tonight. You are spending money on these global giants every single day. But ask yourself this, are you earning a single rupee back from their massive growth? While Indian markets have done remarkably well, US tech giants like Apple, Microsoft, and nvidia have generated staggering wealth for global investors. By restricting your portfolio strictly to Indian companies, you are completely missing out on the world's most dominant monopolies. The best part? You don't need lakhs of rupees, a foreign bank account, or complicated paperwork. In this video, I'm going to show you how to buy fractional shares of top US companies starting with just 500 rupees, how RBI rules protect your money, the tax implications you must know, and a complete 4-step walkthrough to buy your first US stock today. First, let's look at the 3 major advantages to investing in US stocks. Advantage number 1, global monopoly and pure diversification. India's stock market is heavy on banks, IT services, and manufacturing. But if you want exposure to groundbreaking fields like advanced AI, EV hardware, or global search monopolies, companies like nvidia, Tesla, and Alphabet simply don't exist on Indian stock exchanges. Investing in the US lets you own the world's innovation hubs. Advantage number 2, fractional shares. You can buy stocks for just 500 rupees. One share of an elite US tech company can cost hundreds of dollars, which might sound intimidating. But unlike the Indian stock market where you must buy at least one full share, the US market allows fractional investing. That means if a stock costs $250, you don't need to buy the whole share. You can invest as little as $5 or 500 rupees and own 0.025 of that share. Every dividend and price rise applies to your fraction equally. Advantage number 3, the rupee versus dollar currency hedge. Historically, the US dollar tends to appreciate against the Indian rupee by about 3% to 5% annually over long periods. When you invest in US stocks, your assets are denominated in dollars. So even if a US stock stays completely flat in price, you still make gains in rupee terms simply due to currency movement. Now you might be wondering, is it legal for an Indian citizen to buy US stocks? And how does the Reserve Bank of India handle it? Yes, it is 100% legal and regulated under the LRS, the Liberalized Remittance Scheme. Under RBI's LRS guidelines, any resident Indian can legally send up to 250,000 USD, over 2 crore rupees, abroad every single financial year for investments without special permission. Now let's make taxes dead simple so there are 0 surprises. First, tax collected at source, or TCS. For foreign investment transfers up to 7 lakh rupees in a financial year, there is 0% TCS through authorized platforms. If you send more than 7 lakh rupees, TCS applies. But remember, TCS is not an extra tax. It is an advanced tax that you can fully claim back when filing your income tax return. Second, capital gains tax. If you hold your US stocks for more than 24 months, your profits are treated as long-term capital gains and taxed at 20% with indexation benefits. Held for less than 24 months, profits are added to your regular income slab. Third, dividends. US companies deduct a 25% flat withholding tax on dividends, but thanks to the double taxation avoidance agreement between India and the US, you won't be taxed twice in India. There are 2 distinct paths to start building your US portfolio today. Path A is the direct route, investing via specialized cross-border investment apps. If you want to pick individual stocks, like buying specific shares of Apple, nvidia, or Amazon, you can use Indian fintech platforms integrated with US brokerages. Pros, 0 account opening fees, fractional investing capability, and direct ownership. Cons, foreign wire transfer fees charged by your Indian bank. Path B is the indirect route, US-focused mutual funds and index funds. If you prefer complete automation without dealing with foreign exchange transfers or tax reporting yourself, you can invest in US fund of funds through standard Indian mutual fund apps directly in rupees. Examples include NASDAQ 100 index funds or S&P 500 index funds. Pros, invest in rupees via SIPs with standard tax reporting. Cons, occasional investment limits from AMCs due to global RBI limits. If you choose the direct route to buy your first individual stock, here is the exact 4-step checklist to execute in under 10 minutes. Step 1, pick a specialized investment app and complete your digital KYC using your PAN card and Aadhaar. Step 2, fund your US wallet using the in-app digital LRS transfer feature from your Indian bank account. Step 3, search for your target company's ticker symbol, like AAPL for Apple, NVDA for nvidia, or GOOGL for Alphabet. Check the fundamentals, recent earnings, and valuation. Step 4, enter the amount you want to invest, even if it's just $10 or $1,000, and click Buy. Congratulations, you officially own a piece of a global tech giant. Don't just be a consumer of global technology, become an owner. Diversifying into US equities gives your portfolio global resilience and protects your long-term wealth against currency depreciation. Start small, focus on companies whose products you understand and use daily, and think long-term. If you found this step-by-step guide clear and actionable, smash that subscribe button below, hit the like button, and comment. Which US stock are you planning to add to your portfolio first? I'll see you in the next video.